The first thing we'll do is we'll look at the background to the new charity SORPs, why we have them and why we have these changes have come about. We'll then look at the main differences between the 2005, which was the last version of the SORP, and the 2015 new SORPs that we have. Then we'll move on to the key differences between the FRS 102 version of the SORP and the what's known as the FRSSE version of the SORP. And finally, we'll finish off by thinking about what you should be considering now, what sort of planning steps you should be taking. To begin with the background to the SORP, the accounting within the UK is what's known as UK Generally Accepted Accounting Practice, UK GAAP. Now this applies to all organisations in the UK preparing financial reports, not just charities. The existing UK GAAP is to be replaced entirely by Financial Reporting Standard 102 or the Financial Reporting Standard for Smaller Entities 2015. So because we have these large whole-scale changes to the UK general financial reporting environment, we now have to reflect these changes within the charity Statement of Recommended Practice. In terms of timetable, the charity SORP will apply to accounting periods commencing on or after the 1st of January 2015, which is the same period as the FRS 102 application. Now, it's quite important, the timetable here, and what it means is that, for an example, if you prepare accounts at the end of March, the first period of account that you will be applying the new SORP will be 31st March 2016. If your accounts are prepared at the end of December, then your first period of account will be 31st December 2015. This seems quite a bit of time off, but as we'll talk about at the end, it is important to be thinking about this sooner rather than later. You might be thinking, well, can I adopt these charity SORPs early? In normal cases you can, but because the requirement to apply these SORPs for charities in Scotland and in England and Wales is based on accounting regulations, because the current regulations say you must apply the 2005 version of the SORP, right now we can't adopt these new charity SORPs early, but hopefully the accounting legislation will be changed fairly soon, and you could then choose to adopt these new standards early if you wished. So what are the main changes then for these new SORPs, the differences between the 2005 version of SORP and 2015? Well, first thing really to cover is the format of the SORPs themselves, and this applies to each format because they're very alike, just that some requirements are different. The actual SORP itself is made up of 29 different modules that covers different subjects, different aspects of your accounts. The first 14 of these are known as the core modules, and these will apply to all charities, so all charities will need to be cognizant of these and understand them. There are a further 15 modules which apply to particular aspects of charity accounting and particular types of charity. So these won't apply to all charity, but most charities will need to take a number of these into account. Examples of these supplementary modules are charities that are companies. They are charities that have pension schemes, as most charities do, and another example is charities that have heritage assets. It's also worth mentioning at this stage that there is a very useful micro website, and you'll see the address on the screen there, charitysorp.org. You're able to go onto this website and download both versions of the SORP, as well as help sheets which explain the differences between the SORP, and it also helps you understand which version of the SORP you should be applying. In time, the plan is that you'll be going to this website and customize a version of the SORP to your own type of charity, but that's currently under development. The language in the SORP is also different from the previous version of the SORP, and when their requirements are set out in these new SORPs, there are three different types of requirement in terms of what you should do. Where the SORP is saying you must do something, that is mandatory, and it's something that you must comply with, and if you don't, it's regarded as a departure which you must then refer to that in your accounts. Where a requirement is should, that's regarded as best practice. And the final type of requirement is may, and that is one which is a suggestion or an option for you to do. I've also noted here terminology in the new versions of the SORP because of the changes in certain types of the language that we use in the International Financial Reporting Standards, which has driven the FRS 102. These changes in terminology will now flow down into the Statement of Recommended Practice, so you'll see some new terms that you might not have seen before. The application of the SORP, just to mention here that there are certain requirements that are set out in the various sections of the new SORPs that only apply to larger charities. It's important to note that a larger charity in this context is one that is subject to a statutory audit. So if your charity does require a statutory audit, then you'll need to comply with these requirements for larger charities. So in terms of the actual differences themselves, we'll start looking at these at the Trustees Report. Now, the Trustees Report requirements from 2005, these are largely carried over into 2015 versions of the SORP, but we do have some additional requirements. First of these relates to reserves policy. If for all charities, whether you're small or large, for all charities, if you don't have a reserves policy, then you have to explain why you don't have one in your Trustees Report. There are additional requirements for larger charities in the Trustees Report, and the first of these relates to risks. And what you have to do, you have to set out in your Trustees Reports the principal risks and uncertainties that the charity faces, and also your plans and strategies for dealing with those risks. The next new requirement for the Trustees Report for larger charities is about social investments. Now, a social investment is a term you might not have come across before, but a social investment would be one that's made by a charity both to generate financial return, but also to further the charitable objectives of the charity. And where you have these types of investment, then you need to explain your policy for dealing with them in your Trustees Report. The final extra requirement for larger charities relates to remuneration, and you would have to set out in your Trustees Report your policy for remuneration of key members of staff or key management personnel. The final thing I'll just mention here is strategic reports, which is another term that you may have seen in the new versions of the SORP. Now, this is only applies to charitable companies that are over the small company limits, and for charities that fall within this category, you have to reflect some Companies Act legislation which applies to all companies, but involves some additional disclosure or a separate way of disclosing things in the Trustees Report. There's additional requirements there for charitable companies of a certain size. There is further guidance shown in the SORPs for you to help. We'll start off by looking then in terms of the figures in the accounts, the changes. We'll start off by looking at the income and expenditure in the Statement of Financial Activities. On the left-hand side, we have the previous headings under the old SORP, and on the right-hand side, we have the headings under the new SORP. And generally, these are much the same. We have the same number of headings, and they generally mean the same thing. The only major one that's different is voluntary income, which is now called donations and legacies, and this is perhaps an easier thing to understand. So really, in terms of income, not really too many changes. It's probably important to note that if you have core funding, this would also be included under donations and legacies as it was under the previous SORP. Expenditure, on the other hand, there are more changes in the SOFA. Now, if you look on the left-hand side for the current version of the SORP, you'll see that we have 6 heading categories, and these have been reduced to 3 in the 2015 version of the SORP. So the idea of this is to simplify the way that the accounts look and make them easier to understand. You'll see that this heading of governance costs on the left-hand side has now been removed entirely from the front of the SOFA, and this doesn't need to be disclosed in this part of the accounts. And instead, governance costs will just be accounted for as another support cost and disclosed in that way in the notes of the accounts. A few other things just to mention on the SOFA just now, and first of these relates to gains and losses on investments, and this includes both unrealised and realised gains on investments from, say, an investment portfolio or investment property. These previously got reported quite low down in your SOFA, but now these get reported further up before your net income and expenditure. And this is really a requirement that's come through from FRS 102. It won't affect your overall net movement in funds for the year, but it just means that that category is shown somewhere different on the SOFA. The next thing to mention in terms of the SOFA relates to comparative figures. It's now a requirement that for all the figures on your SOFA, for the previous year comparatives, these have to be shown somewhere in your notes. So that is quite a big change from the previous version of the SORP, and could mean extra information to be added into your notes than you might have had before. The balance sheet I've just really mentioned here is just to clarify that there's not really any significant changes in the balance sheet from the previous version of the SORP, other than to say that this new category of social investments and will require to be separately disclosed on the balance sheet. So we've looked at the SOFA, we've looked at the balance sheet, and we'll now consider some changes to accounting policies and other disclosure points. First of these relates to income recognition. Now, previously you had to meet 3 criteria in order to take income into your accounts, and the first of these criteria was that you had to be entitled to the income. The next one was that you had to be able to measure it reliably. And the final one was that the income had to be virtually certain. Well, under the new SORPs, this virtually certain criteria, this has been replaced with the word probable. Now, you might think this makes it easier to take income into your accounts, but I think what you'll have to do is you'll have to look at each source of income you have, look at the detailed guidance in the SORP, and it could be that in practice this doesn't make too much of a change to the way you recognise income. There is also in the new SORPs further guidance on time-related conditions and performance-related conditions in terms of when you recognise certain types of income, and that can be helpful guidance, particularly when you're deciding whether to recognise grants in full in the year you receive them, or whether you think some should be deferred into the following period. And finally, on income, there is more guidance on accounting for legacy income, which can be quite a tricky area for charities to deal with. The next thing I'll mention relates to disclosure of grants payable. If you're a grant-paying charity, this is something that's relevant to you. If you're paying out grants to institutions, under the current SORP, you don't need to disclose the entirety of your grants paid to institutions within the notes of the accounts if you refer to a separate publication that's available. Now, under the new SORP, what you'll have to do is you will have to disclose all of your institutional grants within the notes of the accounts. If, however, you have a website and you specifically refer to that, you can instead put details of the grants on your charity's website. The next point relates to accounting for donated goods. Now, where a charity receives goods for onward sale, then under the current SORP, you have to account for these at the value when you dispose of them, which is an easier accounting treatment. You know the value when you sell them, and that's when you take it into your accounts. The new SORP will require that you actually measure the value of these goods when you receive them rather than when you dispose of them. Now, in some cases that might be straightforward, in other cases less so. There is fortunately a provision in the new SORP that where it's impractical to value donated goods when you receive them, you can instead value them at the point of disposal, but that really shouldn't be seen as a get out from having to consider this and apply it. The final thing to mention in relation to disclosure is about remuneration of key management personnel. Key management personnel, as I think I said before, these are the the people who are delegated the significant responsibility for managing the charity, and you now have to set out in the notes the amount of remuneration paid to these key management personnel, which is a change from before. So we've looked at some changes to policy and disclosure between the old SORP and the new SORP. Let's look at what the FRSSE version of the SORP will provide for us. Well, the first thing to consider is, can we use the FRSSE version of the SORP? This is important because there are reduced accounting and disclosure requirements in the FRSSE version of the SORP, so we need to consider, can you apply this? Now, to do so, you have to be below 2 out of the 3 following thresholds, and these thresholds are a gross income of 6.5 million, gross assets 3.26 million, and a staff count of 50. So if you are below 2 out of 3 of these in both the current year and the preceding year, then you're able to apply the FRSSE version of the SORP. It's probably important to mention at this stage that there is a bit of uncertainty about how long we will have the FRSSE version of the SORP. These smaller entity accounting standards are actually quite likely to be withdrawn in 2016, and there will be a move then into applying FRS 102. It's all very uncertain at the moment what will happen, and we're not entirely sure what the outcome of this will be, but it is something to bear in mind that the FRSSE version of the SORP may only be around, or you may only be able to apply it for a couple of years. When I look at what we think are the main concessions that using the FRSSE SORP will provide for us, the first of these relates to what's now called a statement of cash flows. It used to be called a cash flow statement. Under the FRS 102 version of the SORP, if you apply that, all charities need to prepare a statement of cash flows, and this sets out the cash ins and outs of the charity over the year and reconciles it to in cash at the start of the year and at the end of the year. Now, these statements, these can be a bit complex to prepare, and some people do struggle with understanding them. So if you'd rather not prepare one of these statements, then the FRSSE gives you the option of not doing so. The next important thing to mention in relation to concessions with the FRSSE is related to pension schemes. If you have a multi-employer defined benefit pension scheme where your scheme is unable to allocate the share of the assets and liabilities to the individual members, for these types of schemes, you just account for your contributions to your pension scheme as you make them. So you don't take any asset or liability in your balance sheet. Now, for many of these types of scheme, the schemes are now in deficit, and the members are having to make additional payments under deficit recovery plans, and that can involve fixed payments being made for periods of, say, 3 to 5 years. Under the current treatment, you don't have to accrue for all of these future fixed payments at once, but under the FRS 102 version of the SORP, you will have to take in all of these payments and accrue for them, and that could mean quite a substantial liability suddenly having to be recognised in your balance sheet. Fortunately, if you're able to apply the FRSSE SORP and you do so, then you won't have to accrue your future payments under your deficit reduction plans. I've talked about remuneration for key management personnel already, and with the FRSSE version of the SORP, then you don't have to make that disclosure of remuneration to these personnel. So that could be a benefit that many charities are going to take advantage of. Now, a number of charities have investment properties, and there is a distinction in the accounting, disclosure and treatment between the FRS 102 version of the SORP and the FRSSE version. With the FRS 102 version, investment properties need to be fair valued at the end of each year, and the movements taken to the statement of financial activities. Where you're not accounting for where you're accounting for investment properties under FRS 102, you should be obtaining an independent evaluation from an independent expert, and if you're not doing so, you need to state that in your accounts. Where you apply the FRSSE version of the SORP, then you can just value them at market value, and you don't need to mention the non-use of an independent expert valuer. Holiday pay is something that may not be material in many cases, but where you have the value of pay for employees that they're entitled to, but that hasn't been taken at the end of the year, then you would have to account for that in your balance sheet under the FRS 102 version of the SORP. Again, for the FRSSE, you would have the exemption of not having to do that. In general, it's not likely to be a material figure, but it does save you having to worry about this with the FRSSE. The final thing to mention relates to other financial instruments. Now, another financial instrument is something such as a derivative, a swap arrangement, perhaps a forward foreign exchange contract. Not many charities have these, but where you did have these and you apply the FRS 102 version of the SORP, you would have to account for these at fair value at the end of each year and take movements to the SOFA. Fortunately, applying the FRSSE, you don't have to worry about doing this. That we've covered so far, we've covered the main differences then between the old version of the SORP and the new proposed SORPs. We've looked at the benefits you would get from applying the FRSSE version of the SORP. And the final thing to cover just now is the what you should think of, what planning you should do at this point. Well, the first thing to do really is to think about what SORP you would like to apply. You may find that the benefits, the concessions from applying the FRSSE would be of use to you and you'd like to apply the FRSSE, so see whether you can apply it and then make a decision about which one you're going to apply. The next thing I've got here on the slide is information requirements. Now, perhaps explain what I mean by this by using an example. If you had a 31st March year end, as I mentioned previously, the first set of accounts you prepare under the new SORP would be 31st March 16. Because you prepared a set of accounts under new accounting standards, you have to restate your comparative figures for 31st March 15. And if in turn you have certain figures in your at the beginning of your 2015 year that will need to be restated, and that might be the case where you have valuations, particularly of these derivative or contract arrangements, we have to restate figures at the 1st of April 2014. It's clearly much easier to obtain that information now rather than leaving it till 2 years' time when you decide to prepare your accounts for the first time under the new standards. So it's important to think about these things now. The next thing to consider is the impact upon any covenants that you might have if you have a loan finance. Now, if you have loans, you will undoubtedly have particular covenants you need to comply with, and changing figures in your accounts under the requirements of the new SORPs may well affect this. Therefore, it's important that you look at your covenants, see how they might be affected, and if necessary, discuss these with your bank to make sure they understand the impact, and if you need to, then you might want to see if these can be reviewed or revised. The other parties that will be interested in your accounts will also be your funders. So it's important to consider the implications of the new SORP on your figures, and if you think your funders, this might be of interest to them, or they might view them in a particular way, then flag it up early so that there are no surprises when they see your first set of accounts. And finally, the amendments to your accounts. I've already noted how there will be changes or there will be additional requirement to state comparative figures for figures in the SOFA in your notes. There will be plenty of other things that will change. There may well be figures that you have to recalculate, so it's clearly better to start thinking about these changes now rather than later, because it could be quite extensive. So that brings us to the end of the presentation part of the webinar, and we'll now move on to looking at some of your questions. What I'll do at this point is I will introduce my colleague Irene Gray, who's our technical manager at Chain and Date, to help with me answer some of your questions.
Good afternoon. Since the SORPs have come out, we've had some dialogue with some of our clients, and some of the questions that have come up are things like when will the FRSSE be withdrawn? A lot of people seem quite keen to move to the FRSSE and therefore be able to apply the FRSSE SORP and take some of the concessions that allows you to. As you've already said, it's very up in the air what's going to be happening with the FRSSE at the moment. The FRC have said they'd like to consult by the end of the summer, bring out the consultation when the FRSSE will be withdrawn. and the kind of general view is that potentially 2016 is when the FRSSE will be withdrawn. But in terms of using it now, another question that a lot of people have asked us is to do with the thresholds. What thresholds are there? And Ewan's already covered what the thresholds are. So to qualify as small and therefore be able to use FRSSE, you have to meet 2 of 3 criteria. So there's a gross income criteria of not more than 6.5 million, balance sheet total of not more than 3.26 million, and average number of employees not more than 50. Now, I think a bit of clarity is required. Gross income refers to the total income and resources of the charity in all restricted and unrestricted funds, but it excludes the receipt of any donated asset in a permanent or expendable endowment fund. But that's all outlined in the SORP, the criteria for being able to apply it. So there are 2 of the questions. A third question that we've been asked is who are key management personnel? The remuneration disclosures that you now need to have for key management personnel is over and above what was previously required. And basically that's anyone who plans, directs or controls the charity's activities, so directors, trustees, and it now includes staff members with significant delegated responsibility. So something just to be aware of when you are drafting your accounts, that there are these additional disclosures that will need to be made.
I've got just another button, Irene. I've got another question here that relates to the thresholds, and one of the thresholds, I think you'll remember, it relates to numbers of staff, and it's a figure of 50. And the question is this figure relate to full-time equivalent staff, or is it the total number of staff that you have? Well, this is explained in the SORP, and the actual figure you should be using here is your average headcount. So you might find that if you have a large number of part-time staff, you could actually be over this limit. So that's something that's quite important to think about when you're considering whether you could apply the FRSSE and you're looking at the thresholds.
I think one thing that's important to say is that this is a very high-level review of both the SORPs, and the devil is very much in the detail. So if you have any questions that once you start to look at it and think about how it applies to your charity that you do have, then do feel free to give us a ring or drop us an email, and we can chat through those with you.
I think another question here that relates to the statutory audit requirements, and I was explaining before that larger charities, there's extra requirements for larger charities that are set out in the trustees report and the notes, and this is what and these apply to charities that are subject to statutory audit. Now, in the UK, both in Scotland and England and Wales, if you exceed either of 3.26 million of gross assets or 500,000 of gross income, that means that you're subject to statutory audit, and therefore these larger charity requirements would apply to you. It's actually quite confusing in many ways, because you might think that a larger charity would simply be one that applies the FRS 102 version of the SORP, and a small one would be one that applies the FRSSE. But in reality, the smaller and larger terminology is really a sort of subcategory of that, and really relates to audit requirements. So it's something that's important not to get confused with, because it's not all that clear. Well, I don't think at this stage we've got any further questions, and so I think what we'll maybe do is certainly if you have further questions that you think of later on, and you want to get in touch with us and ask them when you've had a bit more time to think about things, then please feel free to get in touch with us. We'll have updates on the Change in Town website. In fact, I think the slides may already be updated to the website for you to have a look at. There are regular updates in relation to charity issues in terms of accounting on our website. You'll see the address there, so please have a look at that on a regular basis. The next event that we have is planned for middle of September, and this will be a more detailed seminar on the requirements of the new SORPs. So we'll go into things in more depth and look at some of the other things that maybe that we think may be cropping up and are significant. So certainly if you're interested in coming along to that, please let us know as soon as you can. As I mentioned before, if you did have queries, then please feel free to get in touch with either Irene or myself, and you'll see our email addresses at the bottom there. And really that brings us to the end of our time for this webinar. Thank you very much for attending, and thank you for your questions.